All right, it's noon. We're going to go ahead and get started. My name is Jenna Garza. I am your guys' YPN chair for 2020. Thank you all for joining us. Just a little bit of housekeeping. Please keep yourself muted. If you guys have a question, please use the chat box. We'll be monitoring that. And Jordan will answer during or after the presentation, whatever works best. Just go ahead and throw your questions in there so you don't forget, and we will watch them. Briefly, I wanted to introduce Jordan. Jordan Levine is the Deputy Chief Economist of the California Association of Realtors, a statewide trade organization of real estate professionals with more than 190,000 members. Jordan helps to oversee all housing market research at SRCAR, including market statistics, survey research, industry trends, and policy analysis for SRCAR's legislative, hang on, my screen just left me, sorry guys, legislative and governmental affairs. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. Prior to joining SRCAR, Jordan worked in consulting as an economist and director of the economic research, where he oversaw all research and economic analysis on California's economy and housing market, and regularly spoke to trade groups, public officials, businesses, and the media. Thank you for joining us again. And Jordan, I'll let you go ahead and take it away.
Thank you so much. Let me go ahead and share my screen. That way we don't have to stare at my face. That will be better for everyone. Yeah, I got to get them to cut back that bio. That's like longer than my whole remarks today, but I appreciate that very gracious and warm welcome. And I'm happy to be here. I was telling Daniel this morning that this is an area where Southwest Riverside, spent a lot of time as a kid, where my brother and sister still live. Down in Harveston, so it's a fun area to get a chance to talk about there. The news that I'm going to share with you today is a bit mixed, right? We're living in a world of mixed signals. On the good news side of things, we've seen that the decline that we experienced in the economy, primarily in the second quarter, was not as bad as what we had originally expected or what we were originally even told by government agencies. Those numbers have since been walked back and revised downward. So the initial decline wasn't as bad, but more importantly, when you think about it from the standpoint of the recovery, many key begun to move in the right direction. I'll share some of those with you today, but really broad-based growth from just a general macroeconomic standpoint that we've enjoyed pretty much from mid-April, onward through today. And that has finally started to translate through to what we see in the housing market. We have not put out our August 2020 numbers yet, but we have crunched them, and we'll be releasing those next week. And I can say that the recovery continued in August, and we had more robust growth. So unfortunately, I can't just leave the remarks there, because there are some cautionary signs out there that I want to put on your radar, not because I think that things will start to retrench back to where they were, but because the progress, the pace of that recovery may slow because of some headwinds. We expect ongoing progress, but the pace of that progress might be a little bit slower than what we've enjoyed up to this point. Point number one being that there's just lots of pain in our industry. We do a survey of California-based realtors, and what we've seen is that the impacts of realtors that we've talked to here in California, both in terms of like stress, mental health impacts, but also more kind of economically driven impacts to income, the realtor population has been more impacted even than the population at large. So we've seen dramatic impacts to mental health and stress and income impacts, but they're even more acute for us in the real estate sector. The other thing is that even as we continue to make progress, it's the pace of that progress that's becoming more problematic, where many indicators, although better than they were back in mid-April timeframe, aren't recovering near fast enough. And of course, I think for me, the biggest one, and you guys are probably feeling this when I was digging into the data for Temecula, Murrieta, and Menifee, what we can see is that this lack of supply is really impeding this recovery. We initially thought that the demand side of this was going to be the problem, right? When we're up in the 15-16% unemployment range, people are losing their jobs and incomes. But no, in fact, we see that demand for housing is stronger than ever. One of the unique things about this crisis is that it's really improved or increased the value proposition of your home, right? You need your home to do a lot more for you now, and having your own home is a lot more important to people, but we just don't have the units to get people into, right? So lots of buyer demand. but the supply issue is going to become an increasing obstacle to moving the market forward from a closed sales standpoint, not because people don't want to buy, but because we have nothing for them out there to purchase. And then, of course, we've got the wild cards, right? What's going to happen with COVID-19? What's going to happen on the government side? It seems pretty sure now that we won't get any new stimulus before the election. And it begs the question, then what happens after the election? Because we've still, again, got a lot of healing left to do, particularly when it comes to evictions and foreclosures. Lots of people not making rent or not making full rent, not making full mortgage payments. And so how that's all going to play out is still TBD, with implications obviously for us in the real estate market. But let's get into the good news, because there is ample evidence that the worst of this crisis is in fact behind us. In fact, if you look at the Atlanta Fed, they are now expecting a robust rebound in the third quarter. Oops, excuse me. What you can see here, and you can ignore all this crazy text, but what you can see is that as the days have progressed on, their estimate for where GDP is going to be in the third quarter continues to get more optimistic. If you go back to July, they were expecting a 10% rebound, and as of last week, they were expecting over a 30% rebound. And so just to put that into context, we had about a 32% decline in the second quarter. We're now expecting to regain most of the lost ground in the third quarter, at least by the Federal Reserve's estimate. One of the reasons why they're so optimistic is because consumers have come back. You know, it's interesting that even in today's day and age, the US economy is still 70% consumer driven. So business investment, international trade, residential construction, non-residential construction, even government spending, all of that collectively represents just 30% of our economy. And so as go consumers, so goes overall GDP. Well, the good news there is that July marks the first month where the US as a whole has gotten back to pre-crisis levels of consumer spending, which underlies a lot of that positivity from a GDP forecast standpoint that I just shared with you. In fact, if you strip away car sales and the more volatile food category, what you can see is that consumer spending actually had recovered all the way back to pre-crisis levels as early as June. And so this is a very positive sign. And of course, we're seeing that same thing play out in the labor market. So if you go back to February, California had about 17.5 million jobs, about 17.6 million jobs. And then we had some of the worst economic impacts that we've ever experienced. By April of 2020, we had shed 2.6 million and change of our non-farm payrolls. Since April, however, we've added back almost 1 million of those jobs that we lost, such that today, you know, we're still about 1.8 million jobs below where we were before the crisis, but we have created almost 1 million jobs over the course of the last 2 months. And so again, still got a decent ways to go, but a lot of these indicators, the critical ones, have moved in the right direction. In fact, when you look at the unemployment rate, we don't have California's number yet, so we won't get that until Friday, which by my calculation is tomorrow. What you will see is that we made ongoing progress here in California. And in fact, nationwide, we dipped back down into the single digits, which is the first time we've been below 10% unemployment since this crisis began. And so you can see that the broad economy is picking up. And as folks get back to work, that's translated into more consumer spending, which gets even more folks back to work. And you see that playing out across these labor market statistics that I'm showing you here. One of the big questions that I get is like, what's going on with housing, right? Why is housing going so crazy? In fact, if you look at the market in general, you know, the vast majority of the V-shaped recovery has been concentrated in housing. Most other sectors aren't doing as well as we are. So what's going on with that? Well, I put together my computer is lagging, but I put together this, you know, humongously nerdy chart, which no one will be able to understand, but which is really just graphing for you, you know, the job losses on a sector by sector basis mapped against the high wage industries. And I know, you know, only the data nerds like me can really read this chart, but if you break it down to something more simple, what it really means is that 71% or almost 1.8 million of those 2.6 million jobs that we lost were in industries that were earning less than $1,100 a week. And so for me, me, this is really the tale of the tape when we think about why housing demand is so robust. I mentioned how the value of home is more important than it's ever been before, as we ask more of our homes and work from them and don't have to make these long commutes and things like that. But on top of that, the vast majority of the job losses occurred in industries where these folks, unfortunately in California, were not able to seriously consider becoming home buyers in the first place. We've had supply issues for a very long time, which have since progressed into affordability issues and home ownership issues. And so we know only the top income earners in any given area are really eligible, and where we see the economic impacts of COVID were concentrated not in those categories, right? In the sectors like accommodation and food services, our bars, our restaurants, our hotels, people who work in the retail sector, people who work at nail salons, laundromats, all of those service sector oriented things, where unfortunately, and this is a long-term goal that we need to work on, is to get more of those folks able to buy. But, for better or worse, those were not the home buyers in California. And so as those folks have lost their jobs, it hasn't meant a lot to purchase demand, which is why, the housing market is still doing relatively well, even amidst an environment with 15% unemployment back in April. On top of that, we have not just the value proposition of the home improving, right? But we're now below 3% mortgage interest rates. We're at 2.93% last week. And I just called out here where we were back in the 80s, where I distinctly remember my dad walking around bragging about his 12.5% mortgage interest rate back in the early 80s, when all of his buddies had like a 16.2% rate that was prevailing at that time. And so not only is housing more important to us than ever, but and we have more flexibility, but we also have a historically low cost of borrowing to actually achieve home ownership. And folks are, if you're still stable in your job and earning that income and really want to buy that house, this is a great opportunity to do so. And in fact, we see folks scrambling to take advantage of that. In fact, if you look at the mortgage applications number on the right-hand side here that I'm showing you, what you can see is that not only do we maintain healthy growth into the fall of mortgage applications, but actually mortgage, and these are just purchase applications, right? So I've already stripped away all the refis out of this, but you can see just purchase applications are 40% higher than they were during this week of 2019, when we had all-time low levels of unemployment. Now we have 8.5 or 10.5% unemployment, and yet we still have all of this demand that's showing up in terms of a 40% increase of mortgage applications. If you looked at it from the standpoint of buyers asking to be shown properties, you see that the numbers are even more impressive. So not only have we jumped back to pre-crisis levels here in California, in fact, if you compare this orange line, this orange line compares where we are today to where we were in 2019. We're 150% ahead in terms of buyers requesting showings on showingtime.com compared to where we were again in 2019, when we had about a 3.5 to 4% unemployment rate. So you can just see how voracious this buyer demand is, partly because the economy has come back, partly because of those low rates, and partly because of the structural change that has happened as a result of this crisis, where we're all spending a lot more time living, working, being held hostage in our homes. And so we see that showing up in the housing market. In fact, if you look at the July press release that we put out, we had the second biggest increase of all time on a month-to-month basis, with home sales increasing 28.8%, second only to June of 2020, when home sales were up by more than 40%. And so you can see huge impacts on the downside, right? March, April, and May bore the brunt of COVID-19, but we did start to rocket back. In fact, by the end of July, we were already 6.4% ahead of 2019 in terms of closed transactions, right? So we had not just recovered back to where we were in February. July was the first time we actually crept ahead of last year's pace in terms of home sales. I mentioned how the inventory is rearing its ugly head again, and you can see that we fell to 2.1 months of supply, and homes were selling very quickly, a median time going from list to pending of just 17 days. And as a result, we saw home prices increase on a year-to-year basis by 9.6%, almost double-digit growth to a new all-time high level of $666,000. $100,000 here in California. And so this is a testament to both the demand for housing and the lack of supply that's out there. And so for those of us who have our foot on the property ladder, this means that we're all accumulating equity, but it does represent challenges for getting more folks able to take advantage of this unique opportunity to get in at 2.9% mortgage interest rates. Here you can see that graphically, where we had huge declines during April and May in particular, a little bit in March, but mostly in April and May. But, July, we had actually recovered, not just again back to the February 2020 levels, but actually we were at the highest level of home sales of almost 440,000 units that we've had since the end of 2016, when we got the little post-election bump, the Trump bump right after the election in November and December of 2016. You can see the price numbers. Again, we've blown right past the previous all-time high level of $597,000 to a new all-time high of $666,000 here in California on a statewide basis. And when you look at the pending sales, it suggests that things will continue to move forward. In fact, pendings were up almost 25% compared to where they were at this time last year. And of course, I'm optimistic about our region in Southwest Riverside. Here's some reports that we create, which you can download for free every month. The new ones will be out next week, but you can see that we had an even bigger response locally, right? Whereas home sales statewide were up 6.4% from where they were at this time in 2019. Temecula home sales were up 20% from where they were in 2019. Home prices were up 11.5% compared to 9.6%. And you can see that very limited supply of inventory, with active listings down more than 60% and the median time on market of just 10 days, right? So lots and lots of buyer demand locally. You see that in Menifee as well, with over a 27% increase in closed transactions from 2019, and similar numbers on the price growth side. Murrieta was the kind of laggard of the bunch, where it only, quote unquote, increased by almost 9%, which is still much faster than what we see in the rest of the state. These are just a smattering of Southwest Riverside areas. I think we have a bunch. I think we have Jurupa Valley and Moreno Valley and all that. So you can go and download these, but what you can see is a fairly consistent trend statewide that is also showing up in the local market, with sales up big, inventory down big, and that putting severe upward pressure on home prices, and means that homes are selling very quickly. In fact, even faster than they are in the rest of the state, down in the 8 to 10 days between list and pending, right? So a lot of this stuff is playing out right in our own backyard. And you see that in the optimism. When we talk to realtors, we've been surveying realtors every week since this crisis began back the first week of March. But you can see when you ask them about how their business is going in general, they're reporting that things have gotten a lot better, right? More realtors reporting having done a listing appointment last week. And this runs right through September 7th, which was Sunday, right? And you can see more in general listing a property, entering escrow, and more generally trending up, actually closing transactions. When we ask them how they feel about the future, not what happened with your business last week, but what do you think is going to happen with your business next week? In general, realtors were much more optimistic. More people think that listing, sales, and prices will continue to go up, and you guys are the ones on the ground kind of to be able to be in a position to know this kind of stuff, right? And so lots of optimism out there. We've seen the economy getting a lot better, and we've seen that kind of play out in the housing market over the course of the last couple of months. This is where I throw the wet blanket over all those comments and tell you that, you don't want to go out and get your best, Wilson Creek almond champagne or something and pour yourself a beautiful mimosa, because there are still challenges ahead. When we, and I alluded to this at the beginning, but when we asked realtors, California realtors in particular, have you or has anybody else experienced a loss of employment or income since the crisis began? When you ask that, and the census asked this of all Americans, 51% of all Americans said yes, they either lost some income, lost a job, or at least had a reduction in their income. And that compares to 55% of realtors, right? So our members and our colleagues colleagues out there are hurting even more acutely than just the general population at large, particularly when we ask, about stress and mental health. You can see that margin opens up a lot wider for realtors. We're, in some ways, the last bastion of entrepreneurism, right? We're in an industry where we eat what we kill. And so when economic times are hard, it creates disproportionate stress for us. On top of that, just in terms of the psychological impacts, we see that the pace of the recovery has started to downshift. So in August, the US economy added only 1.3 million jobs, 1.4 million. We had been creating 1.7 million the month before that and almost 5 million the month before that. More worrisome is that 355-ish thousand of those 1.3 million jobs that we added last month were actually temporary jobs associated with administering the 2020 census. And so when you strip those away, what it really means is that private sector payroll growth has dipped below 1 million. And that's a significant slowing from the standpoint of a recovery that's still got about 10 million jobs to go to get back to those pre-crisis levels. The other thing is that, there's still a lot of people out there hurting. We have over 27 million, almost 28 million people still on some form of unemployment, whether that's regular state unemployment or this pandemic unemployment that's available for contractors. That's a lot of people, right? We're a 300-ish million person economy, and that means that, we have almost 30 million people. That's not just a 10% unemployment rate. That's 10% of everybody in this country almost. And that's just a lot of folks, who are still experiencing challenges, even as these indicators have started to move in the right direction. That's especially true here in California. In fact, if you lump together the regular claims and the contractor pandemic unemployment claims, we're not only stubbornly high, we've actually started to move back in the wrong direction again, right? With unemployment claims actually going up over the course of the last couple of weeks. I think that last week is an anomaly. I don't think we had 5 million people jump on unemployment, but even if you look at the week before, we still had 3 million on pandemic unemployment. So no matter how you slice it, we're talking about 6 million Californians who either have no or impaired income out there. And just when you look back historically at other recessions and think about how many people are on the dole right now, it dwarfs anything that we've ever seen in terms of concurrent people having lost income. We're not at the 30 million people that we were back in May, but we still have, again, almost 28 million people, which is, 4 to 5 times more than pretty much any other recession in recorded history. So things are moving in the right direction, but we have a lot of healing still ahead of us. And on top of that, we have, a few more headwinds, which is that, I mentioned how most of the job losses have been in these categories where folks haven't, or aren't in a prime, home buying situation. But if you look at the rebound, right, actually the rebound, and these are sorted by income, right? So the ones here that we're looking at on the left-hand side here are the highest wage industries here in California. And you can see that, yes, the declines were much smaller. The dark blue bars, right? We saw much smaller reductions in those categories, but we're also seeing that those industries are much slower to rebound as well. So they didn't shed as many jobs, but they're also not just rocketing right back. And it seems like they're taking advantage of this recession to boost productivity and efficiency and not just bring back all of the bodies if other people can get that work done and spread it out across that existing workforce. And so that will eventually feed through to the housing market, right? When we're not creating as many high wage jobs, it didn't take away as much from demand because we didn't lose as many of those jobs, but we won't get as much growth if those are the categories that are growing more slowly as well. So potential red flag to keep our eye on, that those high wage categories aren't growing quite as quickly. The bigger thing is that we've seen with the rise of COVID in particular, that consumer confidence has started to move back in the wrong direction, right? So we had a really nice resurgence in May and June where consumers kept feeling better and better as they were getting their jobs back and income started to go back up. Then we had to re-shelter in place a bit back in July. And you see that consumer sentiment has taken a step back 2 consecutive months in a row. That again is critical because with 70% of our economy driven by consumer spending. When these folks have to take a step back, when their incomes go down, where they lose some of this unemployment assistance, then they're not able to generate the kind of GDP growth that we need to really help that labor market recovery along. And so consumer spending is a big one to watch. The other thing is that we're going to have a reckoning at some point with all of these folks who are in forbearance on their mortgage, right? If you look at Realty Track, they estimate that upwards of 600,000 foreclosures could potentially be coming down the pike nationwide, which, and we've crunched the numbers on this, translates to about 60,000 foreclosures here in California. We don't have to worry about this immediately, right? Because we have an eviction and foreclosure moratorium through the end of the year. But at some point, we're going to have to reckon with these delinquencies. And a lot of homes are already more than 90 days delinquent on their mortgage. And so, that is yet to play out. We do expect that there will be some foreclosures, but unlike last time, we think that the impacts are going to be in the single digits rather than what they were last time. We have, the government on board, and it's not an every person for themselves type of an environment, right? We're talking about letting these people who are on forbearance work out those missed payments over the course of 5+ years, right? Versus we're not going to ask them on day one of 2021 to come up with a 7-month balloon payment, which, kicks everybody out of their home. We're much more, we realize that it's a pay now or pay later type of a scenario where we can either offer some assistance or face the kind of declines that we saw back in 2008. So we're much more conscious of that. The other thing is we have a lot better mortgage finance undergirding the current cycle. We don't have all those ninja loans that we had last time around. You guys remember those, the no income, no job or asset type of loans that were so popular back in 2004, 5, and 6, and would ultimately precipitated the crisis. On top of that, we have, most homeowners have home equity. They have some skin in the game at this point in time. We didn't see the level of cash out refis that we saw last time. And so as long as you have home equity, even if you lose your job, right, you don't foreclose on a home that you have home equity in, you sell it. Right. And so we do expect that there will be some foreclosure activity, but nothing on the level of 2008. We think it'll be similar to like a 2015 type of a mini dip than a 2008 because the fundamentals are so much different this time around. We do have about 1.7 million households who are also behind on their rent payments, which translates into about 5 million people who could potentially face eviction. And so, I think that this is going to be something that we have to continue to figure out as well, because, the landlords can't continue, many of which have their own mortgages, can't continue to make those payments forever or can't stay in forbearance forever. And that means that they might potentially try and get out from under these homes with implications for prices or foreclose on them. I'm also, hopeful there that the government might step in and give some renter relief, which will ultimately turn into landlord relief as their tenants are able to start making the rent again. And the other thing is that, landlords do still have some home equity. So as long as we don't see those big declines in home prices from a huge wave of foreclosures, actually the biggest challenge I think we have is on the inventory side. So if we got a small increase in inventory because some of these investors wanted to get out of their rental units, that would actually probably be a welcome sign from the standpoint of closed sales when we have just so many buyers and not enough units to put them in. What about in the here and now? That's thinking, down the road and what happens in 2021 and beyond as we work out these kind of policy wrangling aspects. But what about just right here? And this is where I think that, is kind of our biggest fish to fry in terms of closed sales over the next 12 months or even 2 to 3 months. And that's because when you look at active listings across the state, they were down almost 50% in July from where they were in July of 2019. And so again, 3% interest rates that guys like my dad would have killed for, unemployment that's fallen from 15% down to 8%, and this kind of flexibility where you can look for homes maybe wherever you want, and you really want to own your own home now. And yet, this is a humongous obstacle because you might want to buy and you might be pre-qualified and have your mortgage application all ready to go. But if you're in such fierce competition or just can't find a unit, then those don't ultimately translate into to closed sales. The other thing that we're seeing is that with inventory so tight, it pushes prices up, right? And so I already mentioned how prices were up 9.6%. And when you actually melt that together with current interest rates, even though rates are so low, what I'm showing you in these light blue lines is the growth in the monthly mortgage payment. And so what you could see is that rates have been falling for the last couple of years, to the extent that even though prices were growing, monthly mortgage payments on those more expensive homes were actually falling, because the increase in prices was being more than offset by the reduction in rates. Well, what you can see here on the far right-hand side, hopefully, and I know this is verging on being too nerdy to understand this chart, so bear with me, but what you can see is that that robust price growth of 9.6% really eroded all of the benefits of these low rates. So this was the first month in a long time where we didn't see the monthly mortgage payment actually fall by more than 1%. And again, that's just because limited inventory makes the market so competitive that we get this big increase in median prices that kind of, in some ways, cancels out a big chunk of the benefits of 2.9% mortgage interest rates. And you can see that playing out here. And this is an issue across the state. Yes, in Southern California, we're experiencing it most acutely with over a 50% decline in active listings. And I showed you how much bigger that was in Murrieta, Temecula, where it was in the 60 to 70% range. But this is happening all across the state. And what you see is that when you zoom in on a weekly basis, that new listings haven't really increased. These are just new listings, not total actives, but we really haven't had any growth in the number of new products coming on to the market in the better part of the last 2, even 3 months, right? And so we can't sell what's not for sale. And so therefore we shouldn't be surprised that we see on a weekly basis, and this runs again through last Friday, that pending sales have now started to follow suit, right? When we don't get new listings, we can't convert those into pendings. And lo and behold, we see that closed sales are also following suit as well. And so, when you zoom into just the Southwest Riverside market, which I've done for you here, I wanted you guys to have the local data so that you could eyeball it. But in some ways, I didn't even need to bring the local data, because if you look from left to right and just read across this top row, what you see is that basically the same trends are playing out even in our own backyard, where we had this big resurgence in closed sales that have since started to peter out because pending sales have started to peter out, because new listings have essentially been flat since about July. And you can see total active inventory there on the top right-hand side has really, as we've kind of seen this big resurgence in closed transactions, we have certainly not been able to replenish those listings. And so total actives are very low. That's why if you look on the bottom, prices are going up, both in terms of closed and listing prices, and that there's a smaller and smaller percentage of homes, either for sale homes, the actives, or the ones that have actually closed, which actually closed below those original list prices. So market is very competitive, and even more so there in our local market. So if you look at our forecast, and I know you guys are probably getting ready to rip out the shepherd's hook on me any moment, but from an economic standpoint, we do think that the worst of this crisis is, behind us. We have the year-in GDP growth numbers coming in at basically a negative 5% when the dust settles. Overall, we have jobs falling by 6.5% with an average unemployment rate of about 8.8% for the whole year. Next year, we think that the economy will continue to get better and that the worst of the crisis is behind us. This is our baseline economic forecast, but you can see that we expect the economy to expand by 4.2% with another 3% increase in non-farm jobs. That being said, we're still going to have a lot of healing next year, as well as unemployment will average for the whole 12-month period about 7.1%. When we think about the housing market, our baseline forecast is that home sales will go up by a little bit in 2021, and that prices will be up by about 1 to 1.5%. I have to present you with a range and caveats, because there are so many unknowns at this point in time and still a lot of uncertainty. And so when I say that sales will go up by low single digits, as will median prices, what I'm kind of implicitly assuming in that forecast is that we have a vaccine or some other kind of therapeutic or treatment available during the first half of 2021, that we don't have a kind of significant surge in COVID during this flu season that's coming up, but only just a modest rise, not anything that's kind of a second a full-blown second wave, and that the GDP will continue to expand at about a 4.2% rate as incomes rise and rates remain near record lows and inventory stays pretty tight. Of course, this also assumes that we figure out some way to work with these existing homeowners who are more than 90 days behind on their mortgage, and that foreclosures average less than 8% of all sales next year, which is a relatively low level, meaning that the typical foreclosed property would sell for less than a 10% discount. So that's kind of what's all baked in to that scenario that I showed you, where we expect, 3 to 4% increase in closed sales next year and about a 1.5% increase in closed sale prices. What about a worst case scenario? What if we don't get a vaccine until the second half of next year, and we have to do a lot more sheltering in place, that we do get a kind of flu season resurgence in COVID-19, and that California has to shut itself down for another few months this winter or at the beginning of next year? Then we're expecting that the economy won't grow by 4.2% next year. Instead, it will stay basically flat from where we are, that we've kind of figured out how to navigate in this kind of a world, but that we won't be doing any growing. We won't fall significantly, but we won't be able to make much progress. Household income will go down, and that we'll struggle to get some kind of agreement on new federal stimulus. That rates will rise, maybe because the Federal Reserve wants to throw a few more rounds in the chamber and have higher rates. That maybe new inventory comes online because folks are worried about a bigger impact to home prices, and that we get a 20 to 25% increase as sellers try to get ahead of the curve, in which case prices will come down. We'll see more of a 2008, 2009-esque environment for foreclosures, where instead of representing less than 10% of all sales, they represent 30 or more % of all sales, in which case those foreclosures will be selling at much higher discounts than the 10% or so that we estimated in our baseline scenario. So that kind of gives you our baseline, but then the kind of worst case extremes. We also have a best case scenario, just because we don't know what's going to happen, where buyer demand remains robust. Sellers still don't want people coming through their homes, and so we don't get a lot of inventory. And instead of only a 1% increase in home prices, you get something more like a 7-8% increase, and we end 2021 closer to 700,000 than we are to 650 currently. And so just a lot of variables out there to keep track of, but these at least hopefully give you a framework on how to think through what 2021 might look like, depending on what happens on the government front, what happens with this foreclosure and eviction policy, and what happens in the labor markets. And so with that, I wanted to make sure that I left time for questions, but I would just kind of summarize by saying, yes, things have gotten better. When you look in the rearview mirror at all of the economic data, be it, labor markets, unemployment rate, consumer spending coming back, the fact that businesses are more optimistic, that industrial production has started to come around, that interest rates are at levels that I wish my dad were around to be able to take advantage of, because things have really moved significantly in the right direction since mid-April timeframe. No, we don't want to go out and, as I said, dust off your best bottle of champagne, because we've got a lot of challenges ahead of us in the market, namely the fact that 6 million people plus here in the state are still on the government dole and having extreme income impacts. The fact that we have so much buyer demand and not enough supply to put these folks into. That means that, not enough folks who want to buy are going to be able to take advantage of these historically low rates. And the fact that, again, we just have, even as we've made 4 months of solid progress, again, a lot of healing left to do ahead of us. And so just, as a last opportunity before I turn it over to the discussion piece of this is, I would just emphasize that the assistance that we've had from Uncle Sam up until this point has really muted a lot of the effects. Income hasn't taken a big hit, even with all of this unemployment, because there's been a lot of transfer payments from the government in the form of unemployment assistance, PPP, small business loans, PUA, you name it, that has helped folks to maintain their spending on rent, groceries, utilities, all of that stuff, despite the fact that they may have lost their job. But we have big question marks about what that assistance looks like going forward. We're likely not going to get any more before the election. What happens after the election, we just don't know. And that ultimately begs the question of what it's going to mean for evictions, for foreclosures, for this government debt that we've run up and these deficits, and our ability to provide future assistance to these renters to keep landlords made whole and prevent that investor wave of foreclosures, to keep homeowners in their homes and to give them a reasonable time to work out these missed payments so that we don't end up back in a 2008 all over again. Of course, the big wild card is on the COVID and whether we get a vaccine and can kind of put this thing in the rearview mirror and get back to normal, or if we're still kind of struggling through these same issues 6 to 9 months from now. So I remain optimistic, but for me, it's a cautious optimism with an emphasis on the caution. I mentioned that you can download a lot of those reports that I showed you. We hang out at car.org/market data, and you can get all that local stuff for Menifee and Murrieta, Temecula. You can always download these slides on our website as well. You can email me if you ever have any questions. But other than that, I would just say thank you so much for your time. Thank you to Daniel for inviting me. And if I haven't beat you into submission already, I'm happy to entertain any other questions you might have.
Thank you, Jordan. Unfortunately, I had to switch to my phone. I know I saw 2 questions earlier, so if you can see those in the chat, there was a couple questions for you.
Great. Yeah. I see one is on the recording. Those are taken care of, but airline, hotel, unemployment affecting the overall economy after September. Yes, definitely. When you look at the leisure and hospitality sector, I actually subdivided it out into entertainment stuff and bars, restaurants, hotels, but that was absolutely the hardest hit category in our entire economy. And until we have a good operable vaccine or therapeutic, people will get back on those planes, but it's going to be in much reduced numbers. And that's a huge source of growth for us in California, not just because we have our own population base that goes out and goes to Disneyland and spends money or goes up to, do all that fun stuff, but also because we're a huge destination for outside money. That's one of our big growth industries because it's a way to get money in from other parts of the United States and the rest of the world. And so I certainly think that will continue to impact our economic growth at large. Absolutely. I don't think it'll have much impact on the home buying market because, again, if you're working as a cleaner at a hotel, I just don't think that you're buying a home in California these days anyway, but it will have ripple effects that the econ nerds like me like to call the multiplier effects. And then I got another one from Heather that says, where are you getting the backwards data for consumer confidence here in California? The consumer confidence numbers that I showed were nationwide. That being said, we do have a California housing sentiment index, which you can get on our website. Every single month, we go out and do a survey of 1,000 Californians and ask, amongst other questions, is it a good time to buy a home? Is it a good time to sell a home? And those numbers, we actually just closed our September survey. And so if you go to car.org or email me or whatever, I can tell you about housing sentiment here in California in particular. But the numbers that I presented to you were actually the nationwide ones from the University of Michigan's Consumer Sentiment Index. I see another one came in from Pauline as I was rambling on that said, how many people left California this year versus in 2019. We don't actually have good data on net migration for 2020 yet. The best data that we get on migration is from the US Census Bureau, and they're about 18 months behind. So in December of last year, we got the 2018 numbers, and in about 2 months, we'll get the 2019 numbers. So the real answer is that I don't know. But what I can say is that I've studied this issue in detail, and the out-migration has been ramping up since 2010 in a major way. And over the last 5 years, we've lost more than 100,000 people on net. So that's even after you subtract off all the people who moved from other states to California. When you subtract out everybody who left California, we had a net negative of more than 100,000 for 5 years in a row. And unfortunately, I see that trend accelerating, right? Our supply issues have created real affordability issues. And that is going to combine with the kind of enhanced flexibility now that people have with the ability to work remotely. And I think that that's why, I'm optimistic on places like Southwest Riverside, honestly, because you're not kind of chained to that desk in, at Boeing in Long Beach or something like that, or you don't have to drive to Koreatown like I used to have to do every day. And so maybe I can go out to Corona or Murrieta or get a super nice house on the lake in Harveston next to my brother or something like that. But I also think that's the same kind of trend that's going to boost the prospects of maybe even going even farther, right? Maybe why do I go just to Temecula if I can go live in Idaho or something like that? And so I think that, it's going to be a boon for inland, more ample housing supply markets like the Inland Empire. But I also think it's going to be a boon to states that have more affordable housing stocks as people from Google and Facebook and all these are able to work from home forever. That's going to be good for us in Southwest Riverside. But I also think it's going to be great for Texas, Nevada, Arizona, Idaho, and all of those states as well. So the real answer is I don't know, but that's kind of where I see things going from a trend standpoint. I have one more from TC that says, do I believe folks in forbearance may be required to requalify under workout to add payments to the end of the loan? And how might that affect foreclosures? Yeah, I don't know if it's going to be a requalification situation. I mean, you're already kind of on the hook for that debt. And I think that, the banks are going to make the calculation maybe at the, at the gunpoint of the US government, probably to where they're going to have to work it out. They're not going to have a choice. And so we did some quick back of the napkin calculations, but if you missed 6 months worth of mortgage payments and you were able to work that out over like a 5-year time frame, basically what it means is that your original monthly mortgage payment will go up by roughly 10%, right? So if you had a $200 or a $2,000 mortgage payment going into forbearance, right, and they give you 5 years to work it out, assuming again that you just skipped only 6 payments, you're looking at like a $2,200 a month payment for the next 5 years to kind of get caught up. To me, that seems doable, right? I don't think you're going to fully walk away from your home for a 10% increase in the monthly mortgage, assuming you get back to work, right? Your income goes back to what it was, then you can kind of scrimp and save and maybe skip a few years without getting that new car or whatever, and kind of get made whole, as opposed to, last time around, there was no forbearance. And even if you did skip a bunch of payments, come day one of the 7th month, you didn't have a 7-month balloon payment. And so we do think that there will be folks who won't be able to hold on, but that's why, we think that the government is more woke, if you will, to the idea of pay now versus pay later.
There was one other question in there, Jordan. I'm not sure if you saw, because there was some other comments.
No,
and it
please.
was just if you had any forecast or idea on the effect of wildfires. I don't know if you have data from basically what we had last year. If
yes.
you think mirror that, or what we might look back.
Definitely. What we've seen in terms of wildfires in the past, not just wildfires, but other natural disasters as well. So we went back and studied the Paradise fire from a year or two ago. We did the Thomas fire down in LA. I think that was a couple of years ago as well. The mudslides in Montecito and the Santa Rosa fires from a few years ago. And what we saw was that the impacts of these fires take a much bigger toll on the supply side of the market than they do on the demand side. Yes, demand takes a hit in the actual, during the fires, while the fires are actually ongoing. But as the fires get put out, the buyers come back almost immediately, right? That there's people who were in the market to buy before, and as the kind of chaos settles down, they're right back, versus the sell side, either A, a lot of the housing stock has been wiped out, just straight up destroyed by fires, and B, the homes that are there are kind of in regroup mode, right? So you don't see a lot of new listings. And so you see a big decline in sales in the immediate aftermath of the crisis. But then in like months 2, 3, 4 after the crisis, what you see is actually like double-digit growth in home prices as the buyers come back and have to squabble over just a much more inventory is already bad in California, and then you have this kind of a disaster that wipes out housing stock, and it makes the market that much more competitive. And so, there's a big decline in sales, but then a rapid bounce back that translates into big growth in home prices that kind of by 6 months down the road, prices are basically back to where they were before the crisis. All right. Well, this happens a lot. I do beat you guys into submission. I'm surprised you had as many questions as you have. So I know it's a lot of information. The other thing is I'll send these slides to Daniel as well. And we also post these on our website at SRCAR.org. So if anybody needs these or you want to go show your clients, people traditionally think that a recession isn't a great time to sell a home. That's the conventional wisdom. And so I think you have a lot of folks who A, don't want people coming through because of COVID, but B, your common sense would tell you shouldn't be selling your house in the middle of a recession. So maybe some of these stats where you show look at how close to full asking price these sellers are getting. Look how few homes are on the market. Everything else equal, it's probably not the best time to sell a home in a pandemic, but there's definitely something to be said for being the one and only house on the market in a given price range in the midst of an environment with 3% interest rates. So, hopefully the data will be your guide and you guys can be part of the solution for getting some of those would-be sellers to realize that, hey, I'm actually going to sell it quick and get near full asking price. Maybe I should put it on the market.
All right. I think that wraps it up. I don't see any more questions in there. I appreciate you.
Well, thank you guys so much for having me. I enjoyed it, and hopefully you guys will have me back again sometime.
Definitely. Thank you.